Welcome to the Deep Dive. Today we're plunging into, well, one of the most compelling paradoxes in global tech, Semiconductor Manufacturing International Corporation, or SIC. That's 0981 on the Hong Kong Exchange.
Yeah, it's a fascinating one. I mean, how does a company that's, let's be honest, technologically behind its peers and constantly dealing with these really tough international sanctions still manage to get valued so highly?
Exactly. It feels like less of a business bet and more like a high-stakes wager on geopolitics, doesn't it?
Totally. So today our mission is really to unpack all these different forces shaping SMIC. We'll look at its business model, its financial health, what the market thinks, who owns it.
And crucially, those huge risks and opportunities that are basically dictated by global power struggles.
Right, and just for context, we're basing this analysis on August 14th, 2025, and SMIC's share price is sitting at HK $52.05.
Okay, let's get straight into it then. To really understand SMIC, we need to start at the beginning. So, Chapter 1, Business Analysis. What does SMIC actually do?
Okay, so at its heart, SMIC is what they call a pure play foundry.
Meaning they don't design their own chips, right? They build chips for other companies.
Exactly. They contract manufacture. Clients bring the designs. CES prints those designs into actual integrated circuits on silicon wafers. That's their main revenue stream.
But they do more than just fabricate the wafers.
Oh, yeah. They offer a whole suite of services around that. Things like creating photomasks. You can think of those as the really intricate stencils used in chip making, plus wafer testing, final packaging, the whole package, basically. A manufacturing partner.
So their key product isn't really a specific chip, but rather access to their manufacturing lines, their capacity.
Precisely. And that capacity covers a pretty wide range of technologies. You've got the older, mature stuff like 0.35 micron nodes, think simpler electronics.
Okay.
But they also go up to advanced FinFET processes. That's the 3D transistor tech that makes modern chips smaller and more powerful.
And they offer, what, 14 millimeter, 7 millimeter?
Yeah, 14 millimeter, 7 millimeter. And they're even working on an emerging 5 millimeter equivalent process. So they serve quite diverse sectors: consumer electronics, telecoms, automotive, industrial.
Now, you mentioned they're China's biggest and most advanced foundry. They even hit number 3 globally by revenue in 2024, right?
They did, which sounds impressive, but, and this is a big but, their global market share in Q2 2025 was only about 6%.
6%. Wow, compared to...
Compared to the giant TSMC, which holds a massive 67.6%. So, yeah, there's still a huge technology gap.
Okay, that's a stark difference. So how do they even compete? Or maybe compete isn't the right word. How do they thrive with that kind of gap? What's their unique selling point?
Well, that's where it gets really interesting. So SMIC kind of offers two different things, almost like two businesses under one roof.
Go on.
For the Chinese customers, especially big ones like Huawei's Silicon, SIC offers something crucial: a secure domestic supply chain. In today's geopolitical climate, with U.S. sanctions and all, that's incredibly valuable. It's a lifeline.
A safe harbor, basically.
Exactly. Then for some international clients, SWIFAC acts as a sort of secondary source, mainly for older, mature technologies. These clients might be looking to diversify their supply chains, maybe reduce their reliance on Taiwan. So SMIC offers a cost-competitive alternative, kind of a geopolitical hedge.
Right, that makes sense. And this is all happening while the whole semiconductor industry is just exploding, projected to hit $1 trillion by 2030.
Yeah, the demand is massive, especially with AI needing all these high-performance chips. But at the same time, you've got this counter trend. Supply chains are fragmenting.
Because of geopolitics.
Yeah.
The whole onshoring push.
Precisely. Countries are prioritizing national security, building up their own domestic capabilities, like with the U.S. CHIPS Act. Economic efficiency isn't the only game in town anymore.
Which brings us neatly to SMIC's regulatory world. It sounds like a real push-me-pull-you situation.
It really is. On one hand, massive headwinds. U.S. export controls block their access to the most advanced chip-making equipment, especially EUV lithography machines from ASML. You absolutely need EUV for 7 millimeters and below.
Okay, so that's a major roadblock.
Huge. But then, on the other hand, you have these powerful tailwinds from Chinese state policy. Made in China 2025, for example. That means direct government funding, big tax breaks, even pressure on Chinese companies to buy from domestic suppliers like SMIC first.
So, blocked internationally but boosted domestically. What about actually getting into this business? The barriers to entry must be insane.
Colossal. Forget the politics for a second. Just building one advanced chip factory, a fab, costs upwards of $20 billion.
$20 billion.
Yeah, and then you need vast amounts of intellectual property, years of know-how, and there's a global shortage of skilled engineers. It's incredibly difficult to break in or even scale up.
Which makes SMIC's position even more unique. So what is their competitive advantage, their moat? It doesn't sound like a traditional one.
It's definitely unconventional globally. Their moat is pretty weak compared to TSMC, but within China, it's incredibly strong. They're the designated national champion.
But what about costs? You mentioned the tech gap. Does that make them less efficient?
Yes, significantly. Because they can't easily get EUV, they have to use older DUV technology with really complex techniques for their advanced chips. It works, but it's much more expensive. We're talking maybe 40–50% higher production costs than TSMC for similar advanced chips.
Wow. So less advanced and more expensive. How does that...
But here's the twist. The U.S. sanctions, paradoxically, have kind of created this near-impenetrable domestic moat for them.
How so?
Because major Chinese tech companies like Huawei are largely blocked from using TSMC's most advanced services. So who do they turn to?
They have to turn to SMIC.
Exactly, they're forced to.
Right.
This guarantees SMIC demand. Over 84% of their revenue now comes from China. And that guaranteed business gives them the scale and the cash flow, even if margins are tight, to fund their hugely expensive R&D and build more fabs. The external threat literally became the foundation of their domestic strength.
That's incredible. An accidental state-reinforced monopoly almost. But doesn't that risk making them, I don't know, complacent if you know you've got the market locked up domestically?
That's a really good question. It's definitely a potential risk, that double-edged sword. Does the domestic shield ultimately hinder their global ambition long-term? Maybe. For now, though, their focus is clearly on domestic self-sufficiency first.
Okay, that business model is truly unique. Let's shift gears now and look at the people running the show. Chapter 2, Management Evaluation.
Right, the leadership. It's a seasoned team. You've got co-CEOs Dr. Haijun Zhao and Dr. Liang Meng and Chairman Dr. Liu Zhongfeng, and you have to give them credit for resilience.
Developing 7mm and even that 5mm equivalent process without EUV, that's genuinely impressive technically.
It really is, and that leadership has steered the ship through choppy waters, growing revenue from about $3.6 billion in 2018 to over $8 billion in 2024.
This strategy seems to have been a very deliberate pivot inward, right? Leveraging the sanctions almost.
Absolutely. Co-CEO Zhao Haijun has been pretty open about it. Strong domestic demand, plus customers stockpiling chips just in case, has shielded them from the worst effects. They effectively turned a crisis into a domestic market share grab.
Building that protected ecosystem within China.
And bringing in Dr. Liang Meng as co-CEO was a very calculated move, maybe controversial given his history.
The TSMC trade secrets allegations with Samsung, you mean?
Yeah, that whole saga. But it underlined his world-class technical expertise. Hiring him signaled SMIC was adopting, let's call it a wartime mentality. Technical progress was the absolute priority, whatever the background noise.
Okay. What about transparency? How open are they?
Their financial reporting is reasonably clear. They acknowledge the tough geopolitical environment openly, but there's that layer of opacity that comes with deep state connections.
Like the US DoD naming them as having military ties.
Exactly. That's not something you see with, say, TSMC or global foundries. It adds a level of uncertainty for international observers.
And their capital allocation strategy. You mentioned reinvesting everything.
Everything. It's single-minded, aggressive, doesn't even cover it. Capital expenditure was nearly $2 billion in Q2 2025 alone. That's staggering.
$2 billion in one quarter.
Yeah. Management's message is clear. Build capacity, push R&D. Shareholder returns like dividends or buybacks are just not on the agenda right now.
Which leads to the obvious point. No dividends, no buybacks.
Right.
What does that do to their return on investment metrics?
It tanks them, basically. Their return on invested capital, ROIC, is incredibly low, just 0.88%.
0.88%. That sounds terrible from an investor perspective. Isn't that a massive red flag? Is it poor management?
Well, here's the paradox again. If this were a normal company focused purely on profit, yes, spending billions for almost no return would look like terrible management.
But it's not a normal company.
Exactly. Their primary goal isn't maximizing shareholder value in the traditional sense. It's executing a national strategic mission, building a self-sufficient Chinese semiconductor industry.
So the main shareholders, the state-backed ones, they're not looking for dividends. They're funding a national project.
Precisely. In that context, the low ROIC and massive reinvestment aren't signs of failure. They're signs the management is doing exactly what it's supposed to be doing according to its primary mandate.
That reframes it completely. Okay, with that context, let's dig into the numbers themselves. Chapter 3, Financial Analysis.
Right, the financials. Scale-wise, it's a big company, market cap around $65 billion US. Revenue growth has been, well, volatile, but ultimately strong. There was a dip in 2023, but a big rebound in 2024. They're tracking towards maybe $9 billion annually by mid-2025.
So impressive top-line growth.
Yeah.
But you mentioned profitability earlier.
Yeah, that's where the pressure is. Those
Yeah.
massive investments in new fabs mean huge depreciation costs hitting the books. Plus, all that R&D spending, it really squeezes margins.
How much have margins fallen?
Gross margin was up near 38% in 2022. By 2024, it was down around 18%. Q2 2025 saw it recover slightly to 20.4%, but they guided it lower again for Q3. Net profit margin for the last 12 months is only about 6.1%.
Only 6%. And free cash flow?
Consistently deeply negative, like negative $5.23 billion in 2024 alone.
Minus $5 billion.
Yeah. Again, it underscores that deliberate strategy. Growth and tech advancement first, cash generation later. Much later, perhaps. And it's only possible because of that strong state backing.
But despite burning through cash like that, you're saying the balance sheet is stable.
Surprisingly, yes.
Wow.
Their debt-to-equity ratio is actually quite moderate, around 36.5%, and their current ratio, which measures short-term liquidity, is healthy at about 1.7.
Where does the stability come from?
It comes directly from those state-backed capital injections. That provides the equity base, keeps the debt ratio manageable, even with all the spending, and no dividends means cash isn't leaking out.
Okay, which brings us back to the big paradox you mentioned right at the start.
Yeah,
the
right.
valuation.
The valuation, it's
Yeah.
wild. The price to earnings, or PE ratio, is extraordinarily high. It's been bouncing around between 90 and even over 190 times their trailing 12-month earnings.
190 times earnings.
Compared to its own history, that's very high. And compared to competitors like TSMC, which trades at a much more conventional 25-30 times PE, it's just off the charts.
So the market is clearly not valuing SMIC based on its current profits, which are pretty thin. What's going on there?
It really looks like the market is pricing in a massive geopolitical premium.
Meaning
investors aren't just looking at SMIC as a chip maker, they're seeing it as a strategic asset for China. A bet on China successfully achieving technological self-sufficiency in semiconductors. It's valued almost like a quasi-monopoly and waiting for that huge domestic market.
So it's a bet on future strategic dominance, not current financial performance.
Pretty much. When you compare SMIC's metrics PE, ROIC to peers like TSMC, Global Foundries, UMC, it's a total outlier. And trying to do a traditional valuation, like a discounted cash flow or DCF model,
It must be almost impossible with negative cash flow.
it's incredibly difficult and highly speculative. Any DCF model becomes super sensitive to your assumptions about when they might become cash flow positive and what kind of massive growth you plug in. Like, you need maybe 20% plus earnings growth initially, then settling down to 7-9%.
And you have to choose a discount rate, the WACC.
Right. A weighted average cost of capital, maybe somewhere between 8.5%, 10.5%. But even applying a standard WACC feels a bit weird for a company driven so much by a national strategy rather than pure profit motives. The usual rules don't quite fit.
All right. So we've unpacked the business, the leadership, the unique financials. What's the main takeaway for you so far? It's definitely not your standard tech company, is it? It really makes you question how we value things.
Absolutely. That interplay between state direction and market forces is just unlike anything else. It's fascinating. We've set the stage for this paradox, and if you're finding this deep dive useful, we've got more to unpack.
Definitely stick around. But first, a quick word about how you can keep getting these kinds of insights.
That's right. Make sure you don't miss future deep dives. Hit like and subscribe on the Stock Analytics AI YouTube channel. For just €4.99 a month, members get priority access to deep dives on tickers you choose. And we're gearing up to cover all the S&P 500 stocks over the next few months. Members get first dibs.
And if there's a specific company you want us to look into, just drop us a super thanks on YouTube with the ticker.
Okay, and we're back. We've looked inside SMIC, now let's zoom out a bit. Time for Chapter 4, Market Sentiment. What's the vibe around this stock?
Well, officially the analyst community has a buy consensus, but that hides a lot.
How so?
The range of their 12-month price targets is huge. It goes all the way from HK $25 on the low end up to HK $68 on the high end.
Wow, that's a massive spread. HK $25 to HK $68.
Exactly. It screams uncertainty. Analysts just fundamentally disagree on how these big geopolitical risks and opportunities are going to play out. It's very binary.
And the news flow, the media coverage, must be pretty volatile too. Highly polarized. One day you get negative headlines about new U.S. sanctions, or maybe they miss earnings estimates, like that 19.5% net profit dip in Q2 2025, and the stock takes a hit.
Right.
The next day, there's news about a technological breakthrough, maybe them making advanced chips for Huawei, and suddenly there's a wave of optimism, and the stock rallies. It's a classic battleground stock. Trades heavily on headlines and sentiment swings.
So technically, moving averages and things like that.
As of our analysis date, technically it looked somewhat bullish in the near term. It was trading above its 50-day and 200-day moving averages.
Okay,
But there's also persistently high short interest. Somewhere between 5% and maybe 10% of the daily trading volume is from short sellers betting against the stock.
so lots of people betting it will go down.
Yeah. It makes it a playground for short-term traders who like volatility, but for long-term investors looking for stability and predictability, it's a much tougher proposition.
Okay, a volatile stock driven by news and disagreement. But who actually owns the company? Who calls the shots? Let's peel back the curtain on Chapter 5, ownership structure.
Right, and this is fundamentally different from your typical global tech firm. SMIC's ownership is heavily influenced by Chinese state-affiliated entities.
Like who?
The single largest shareholder is the China Information and Communications Technology Group. That's a major state-owned enterprise holding about 16.8%.
Okay, a big chunk right there.
And then you have China's big fund. That's
Yeah.
the huge national investment fund set up specifically to boost the domestic chip industry. Various arms of the big fund hold significant stakes too, like around 5.0% from one phase and 1.6% from another.
So add it all up.
If you look at the top 25 shareholders, they're overwhelmingly state-linked firms, and together they control over 36% of the company.
36%, that's effective control, isn't it?
Absolutely. It gives the Chinese government directive control over SMIC's strategic decisions. It's not just influence, it's direction.
And what about the managers themselves? Do they own much stock?
Almost none. Direct insider ownership is negligible, like 0.0334%. And you don't see executives making big open market buys or sells.
What does that tell you?
It suggests that the management team aren't primarily motivated by personal wealth tied to the stock price. They're likely state-appointed technocrats. Their incentives are aligned with national strategic goals like achieving semiconductor self-sufficiency for China, rather than just boosting the share price quarter to quarter. Success for them is measured differently.
Measured by national progress, not just company profit. That makes the state's role crystal clear.
Okay, let's pivot to the potential downsides. Chapter 6, Risk Assessment.
Yeah, the SWOT analysis, strengths, weaknesses, opportunities, threats. It really highlights how SMIC's fate is tied to this constant push and pull between state support and foreign sanctions.
What are the key connections there?
It's almost circular, you know? Its biggest strength is that unwavering state support. That directly counters its biggest threat, which is those crippling U.S. sanctions.
Its biggest opportunity is import substitution, basically, replacing foreign chips with domestic ones within China. But that opportunity only really exists because of the sanctions blocking access to foreign suppliers.
Right, the sanctions create the captive market.
Exactly. And its main weakness, that technology lag we talked about, is also a direct result of sanctions blocking access to the best equipment, like EUV. Strength, threat, opportunity, weakness, they're all deeply interconnected through this geopolitical lens.
What about specific risks on the horizon, like those potential new U.S. tariffs on chips?
Yeah, the talk of a potential 100% U.S. tariff on imported chips in 2025. Management tends to downplay the direct impact, pointing out that only about 12.9% of their revenue comes from the U.S. anyway.
But the indirect effects could be bigger.
Much bigger. A move like that would just accelerate the whole technological decoupling trend. It would further entrench SMIC within its protected Chinese ecosystem, but also cut it off more decisively from the global market. It reinforces that golden cage idea.
Makes sense. Any other big risks? Macroeconomic ones.
Definitely. This is a super capital-intensive business. Building fabs cost billions. So SMIC is vulnerable to rising interest rates, which would make financing all that expansion more expensive.
And the economy in general.
Yeah, a global recession would hit demand for consumer electronics hard. Fewer phones, fewer PCs means fewer wafer orders. That would amplify the natural cyclical downturns that the semiconductor industry always goes through.
Okay, a complex web of risks. That leads us to our wrap-up, Chapter 7, Conclusion.
So, putting it all together, the investment case for SMIC really is, as we said at the start, a study in contrasts. It boils down almost entirely to your view on this big geopolitical game, much more than just traditional business fundamentals.
Right, so let's spell out the two sides. What's the bull case? The optimistic view.
The bull case goes like this. SMIC is China's chosen champion in a strategically vital industry. Beijing simply won't let it fail. The U.S. sanctions, maybe unintentionally, have handed SMIC a huge protected domestic market on a silver platter, guaranteeing demand.
And technically,
Technically, they've shown surprising resilience and ingenuity, closing the tech gap faster than many expected, even without EUV for some nodes. So the bulls see SLUC becoming the undisputed leader in China's massive internal semiconductor market, regardless of what happens globally.
okay, that's the optimistic take.
Eh?
Now the bear case.
The bear case sees SMIC trapped, caught in a geopolitical vice that could tighten further. More export controls from the U.S. and its allies could genuinely cripple their ability to advance technologically.
And fundamentally, the business itself.
Fundamentally, it's inefficient. It burns through billions in cash for very low returns on capital. Without guaranteed access to next-gen tech like high-NA EUV down the road, that technology gap with leaders like TSMC might become permanent, leaving SMIC stuck making lower margin, less advanced chips.
And the valuation, from the bear perspective.
Sky high and completely detached from the weak underlying financials, it's just a speculative bet on a very uncertain geopolitical outcome, not a reflection of business reality.
And as we discussed, trying to put a traditional valuation number on it, like with DCF, is incredibly difficult because of the negative cash flow.
Extremely difficult. Any model is just super sensitive to assumptions you make years down the line. That huge range in analyst price targets HK $25 to HK $68 perfectly illustrates just how much uncertainty there is. Nobody really knows.
So where does that leave us with the current share price? HK $52.05 as of our analysis date.
Well, HK $52.05, it seems pretty clear the market is leaning heavily towards the bull case. It's pricing in a future where SMIC overcomes the challenges and achieves that strategic dominance within China.
But it's crucial to understand this isn't your typical stock pick.
Absolutely not. An investment in SMIC isn't really a conventional investment based on earnings and cash flow. It's a high-risk, high-reward gamble. You're betting on the political will and technological capability of the entire Chinese state apparatus to build a self-sufficient semiconductor powerhouse against determined international opposition.
The outcome depends more on politics and breakthroughs than profit margins.
Exactly. Which leaves us with a final thought to ponder.
Go ahead.
In this world that seems to be fracturing more and more, is SMIC's journey going to redefine what success means for a tech company? Could success mean fulfilling a national strategic goal, even if profits are secondary? Or is China just building an incredibly expensive, technologically lagging, gilded cage for its tech industry?
A provocative question indeed. And if you enjoyed wrestling with complex questions like that in this deep dive, make sure you like and subscribe to the Stock Analytics AI YouTube channel. Remember, members get priority deep dives, and we're tackling the entire S&P 500 soon. Plus, you can request a specific deep dive with a super thanks.
And the important reminder, this analysis was generated by an AI system. It's for educational purposes only and definitely isn't financial advice. Please always do your own research or talk to a qualified financial advisor before making any investment decisions.
Thank you for joining us on this deep dive. Until next time, stay curious and stay informed.